Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by.
Study Investing, wanted to do a quick catch up with you. Going to look at the portfolio management tool that I put out and some of the actual performance. Essentially, I put together a 12% expected returning portfolio. I started about 2.5 years ago after realizing that stock picking was not as easy as I thought it was going to be, despite my Master's of Finance and really loving, getting perfect scores in equity valuation. That it was tricky. So I kind of, 2.5 years ago, kind of said, let's go back to some of my fundamental training and put this together. So I will skip over here real quick and we'll look at it. I guess I should say something about what is modern portfolio theory. Modern portfolio theory is basically picking a bunch of assets and doing some data analysis on them, and essentially plotting their return and standard deviation profile. So standard deviation on x-axis, return in percent on y-axis, and essentially using Excel to find like an optimal point for all your risky assets. Here you could visualize it as this yellow dot. I know there's a lot going on here, but I'm just going to give you the brief overview. And then the basic idea is this will be a high risk, high return portfolio, but it's going to be the best assets you have. And then the idea is find the best ones, and if those are too risky for you, then just dilute them with some treasuries, right? So if like you find your best assets, but it's like, in this case, what is it? We're basically at like 28% return and a risk profile that's double the S&P 500 or the NASDAQ. So these are very, you could say, risky strategies to be all in on S&P 500 or NASDAQ. In fact, in the 2000.com bust, NASDAQ from peak to trough had, I think, almost an 80% drawdown. Okay, so NASDAQ's pretty wild, can be pretty wild ride. S&P, I'm not sure. Let's say it had a 50% drawdown because it's a little less risky than NASDAQ. 50% drawdown in the 2000.com bust. Okay, well, like I said, this yellow dot here is twice as risky as S&P 500. So most people do not want to be in something that's twice as risky as the S&P 500. But since these are our best assets, the idea is find this and put some money in there, but not all. Basically take a chunk and put it in treasuries that has like a guaranteed, say, 4% return, something like that today. And so dilute it down, just easy, dilute it with something safe. And so you're still holding those assets, but you're just not all in on those high risk, high return assets. And essentially this won a Nobel Prize. And that's why they teach in graduate school. And that's why during COVID I was like, well, let's see if I can put a course together. And the only thing I haven't tried is putting it on like Udemy. That might be my next move. But I built a course. I sell these spreadsheets or Excel sheets. It just hasn't worked financially. However, I was talking about this with some people that I met recently, and I was telling them, this is really great. Great stuff. Let's go and look at the performance really quick. Like I said, I started May 2023. Now we're January 22nd, 2026. And it's had an annualized return of 14.75. So better than the 12% that I designed it to return. And you can see some of the other things. These are cumulative numbers. So we're there at the bottom at 44.57% return. NASDAQ had an 88.64% return. I'm going to drop the decimal places. So we had a 44% return. NASDAQ had 88%. S&P 500 had 71%. Small cap did 49%. And Bloomberg U.S. Aggregate Bond Fund had a 12% return. So we're in the running. But what I love about this is it has a basically 60-40. Yeah, here we go. Allocation, so 60% in equities, 40% in fixed income. And the fixed income that I've been running is in TLT. TLT is a long-term U.S. bond fund. And what that means is what I'm basically happy about is I'll take the 4.5% coupon on those and just let it reinvest and just snowball until we hit the day when something breaks in the economy and we have the next bust and the government cuts interest rates significantly. And when that happens, mathematically, TLT should increase by a large amount. I don't know, about 20% return positive on the price for every 1% reduction in the interest rates on the 20-year bond. Something like that. Something in that category. So you could be looking at 40-60% return in the next big crash. Until then, just keep taking the 4.5% dividend or coupon. The 60% return is something like 15% in small caps or large caps, U.S. large caps, not international, but U.S. large caps, 15% allocation. 33% to something that obviously I can't tell you everything because I'm trying to sell this, but it's only $2 a month, I think, to get the subscription. And then U.S. small cap, 11.43%. So obviously a lot of people have done well. We're at all-time highs. S&P 500 is at almost 7,000 today, early January 2026. So, it's not like no one else has made money and I'm the only one that came up with some idea. But I've just loved it, and it's been better than, like I said, some of the learning that I've done or the losses that I've taken up to this date trading Moderna as a short position. Not that I haven't made some money, but I think it's been net loss. And so I want to be transparent about that. I would say other housekeeping items. David Rogers Webb. Turn this back on. David Rogers Webb, who wrote The Great Taking. I did a lot of work on him, trying to assess what's sort of the worst case scenario, given that you have a lot of people that are talking about a change in financial system. You have Ray Dalio talking about that from Grand. I'm forgetting the firm he worked for out in Connecticut. It doesn't matter. Ray Dalio. You see these huge movements in countries buying gold and silver, or just the huge run-up in precious metals, and sort of sell off on U.S. bond funds. And a lot of people talking about Ripple and all this new blockchain stuff and some recent things that came out with the SEC. And anyway, David Rogers Webb sits right in the middle of that conversation, and he talks a lot about huge problems of all these assets that we hold in these accounts not being ours. They're not specifically ours. It's just generally you have a claim to some number of shares, but no specific share. And that a lot of our assets are used by the financial institutions as collateral for other things that they want to do, and that actually the collateral is used again and again and again multiple times. So there's essentially a huge problem with being in these markets. And so it goes without saying, that puts me in a really weird situation to be someone who's building models and got training in models and training in investment and financial services for a system that David basically says is very, 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 very troubled, intentionally troubled. So David's an interesting guy. Go check him out. He's got some new stuff out there. So for me, I'm kind of this weird conglomeration of traditional finance training, but some concerns about markets, definitely concerns about mRNA tech. And so I don't know if this is helpful for you. I probably will not have these Excel sheets available for forever, but for right now, we have the course where you can learn modern portfolio theory without going to graduate school. And also you can just pick up one of these models if you're just not sure what you're doing. The big impetus of why I decided to make this video is, one, I haven't done one of these in a while, and then two, I was talking to a couple of people recently where I just sent them this model for free, and one person was telling me about their skills in accounting, but that they never gathered any skills in finance, and so they just send their money off to Edward Jones to be managed. And I told them one of the reasons I put this together was that they're probably going to send $600,000 of returns over 30 years to their financial advisor. And Jack Bogle and a lot of other folks, Warren Buffett, argue that financial advisors generally are not able to outperform the market. And so that if you could just learn some very basic portfolio management skills, whether you use this or use something, I'm not sure what another substitute for this would be, but something just fairly easy, like maybe 60% in VTI, which is the basically U.S. all equity fund, and like 40% in a bond fund or something. Do something like that. That probably you could, just doing something with like a 2-asset strategy like that, beat your financial advisor performance. I don't know if that's going to be exactly true in your case, but I'll tell you that my parents have used those services before, and the people that became advisors, they're not bad people at all. And I'm not talking poorly about their former professions, but one was former U.S. military, and the other was former U.S. law enforcement, and they got into financial services. And as far as I could gather, they had kind of picked up some of the jargon and lingo, but they had no mathematical or technical understanding of any of the picks or the calls or any mathematical backing for talking about risk assessment with my parents as their clients. And so I've questioned heavily whether people taking $1 million over to your local Edward Jones or whatever is really that smart. I think people basically sacrifice a ton of money to those organizations through fees. Like I said, $600,000 under these situations, under this scenario. A person like you or I puts the max Roth contribution, $6,500 into the account every year for 30 years. The advisory takes a 2% fee annual, and the portfolio returns 12% annual on average over those 30 years. Your advisor is going to take $600,000 off of you. For what? For what? They have zero risk personally in the game. I think people pay that money so that they don't have to feel like they are responsible for their own money. And if they lose big, that they don't have to feel guilty about, crashing their financial future. They can blame it on their stupid advisor. I don't know that that's worth $600,000, honestly. And the other thing is, on the opposite side, I think people like to be heroes. They like to be financial analysts from home in their spare time through Facebook groups and whatever else, and think that they're going to outsmart everybody. And so they're going to, make these, like they're going to have some special knowledge and insight on Tesla and the future of that based on something or Wemo or chips or U.S. military or energy or gold mining or something. Like, that's been my mistake, I think, is like, I got a little arrogant. I thought, hey, I have a master's of finance. Like, I got perfect scores in this equity valuation thing. Like, I can tell the difference between a stock that's going to do really great and not. And it's like, honestly, guys, I've not done that well in that. There's been wins. There's been wins in gold and silver. There's been wins in uranium. There's been some money made shorting or going long Moderna. There's been some money made on crypto or crypto miners, but there's been big losses on, say, like pandemic companies that were going to provide treatments. Yeah, so I think that's kind of like the story for me, and about being as honest as I can without like just giving away the assets and the weights for the portfolio. All right, is that a good update? I think so. I think that's a fair update. Anyways, hope you're doing well out there. Stay warm. I guess check out David Rogers' web and figure out what you're going to do with him and his information. Keep your eye on the gold and silver, precious metals markets. It's a real tricky thing to try to figure out how to go forward. There's a lot of smart people that turn on their webcam and talk about markets and the economy. Not Whitney Webb, who am I thinking of? Sorry, I was overseas for a couple weeks. I'm half jet lagged and I've been out of all the market stuff for a while. But, people talk about the housing. People talk about the defaults or the vacancies in commercial real estate office in the United States. People talk about wars. People talk about the weird thing about who's buying up all this precious metals, and are we really heading towards some sort of reset or something? That's where David Rogers' web seems to come in for me, talking in the most, educated and also hyper concerning terms. And that's never good, right? When the guy that seems to know the most also has the worst forecast. I think that should cause us to pause and think, what are we doing here? We're in the middle of a huge bubble. Man, people are making a lot of money on stocks. Crypto's down. So, That's all I have to say. We'll talk to you next time. Thanks.